Your job on their side of it is to provide whatever assistance, let us know about the claims coming in. We work very closely with your prosecuting staff as well as your claims manager. You just kind of keep us in the information loop, and vice versa. We have responsibility back to you to keep you in the information loop. And for the most part, it's a very good symbiotic relationship. I mean, none of the counties want to impact each other. I mean, clearly, we don't want to do that, and we want to make sure that we handle these things in a proper manner. Let's see. Did you want to go into other? Let me just, before we drop the I know we have one other issue that's a side issue that we want to talk about. But the property program that you are part of is unique in the state in that, remember that map with all 28 counties? Well, the insurance company that when we go out to the marketplace, we present them with this bucket of assets spread across this geographic area of those 28 counties. Courthouses and public works buildings and community centers and footbridges and you name it, it's out there. When they look at it, they go, wow, our risk is spread over a big geographic area. So we know that there's not going to be a flood or earthquake or a wildfire that's going to affect all those assets at the same time. And because of that, we're able to get very large limits, particularly in flood and earthquake, where, especially for Jefferson County, where you get earthquake is a major concern. The sub-limit for Jefferson County is $250 million for earthquake and flood. Well, your statement of values isn't quite up to $250 million, so the whole thing went down. Every asset you have, there's enough capacity in the policy to cover everything that you have listed on your statement of values. Similarly with flood and wildfire. But the total package is $500 million or $500 million. So you're well covered. We've been doing a lot of work on making sure that the values are uniform across the landscape. Some counties were really good at keeping the values up to snuff. Others were kind of catch you can. So we've been working with your folks to get them all valued at least equally so we can distribute the premium correctly. I mean, that's all that's about, is making sure that everybody pays equitably under that premium cap. But it's just a big, giant, huge conglomeration of assets that they're insuring, and it works out really well from a pricing standpoint. And I know we want to get to other issues. In your packet, on the left-hand side is this interesting bar chart. This also affects your premium, so if you look on the one with the big green line, column number 5 is what they call an experience modifier. Each of the member counties has a rating, an adjustment to the premium based on their past experience. And you can see on those, your spot, you're just above 1, and these bars are going down, that you're just about 1, or just above 1, which means you're paying just a little bit more than the average. And so 1 would be the average. That would be the perfect county that had just the right number of claims that would be average amongst all the pool members and all this kind of stuff. So as your experience is positive, you get either a credit to your premium, or if it goes the other way, if it's negative, that is, you're more expensive to the average of the pool, then you pay a bit of a surplus. In your case, you can see how those bars are headed down, and because of that, your experience modifier is getting better, and you are paying less as a premium surcharge. The big spike occurred when we had the death in the jail, along with a number of issues out of the jail and the correction side of the house, and it was a bad experience. And so now those are starting to get written off, so to speak. And we suspect that next year you'll be down at 1 or right at 1. And so the good news is you're headed in the right direction. The issue what we try to do is that we're trying to look more at frequency than severity. That everybody's going to get their time in the barrel, and there's going to be a case that comes out that no matter how much risk management you do, it's going to happen. Those are not what's driving the chart. What's driving the chart is multiple bad things. And so these are all capped at $100,000, so we don't worry about claims over $100,000 because those are time in the barrel kind of claims. But if you have multiple ones, like which came out of the jail, we had 3 or 4 of them that manifested out of that whole circumstance. Then that's a kind of a frequency thing. And so we go, well, we want to reduce frequency, and so we want to reward those that have good loss histories and less frequency, and kind of raise the flag to those that don't. To you, and then we'll get to your question.
And also, I wanted to observe a couple of things.
I was going to say, Bill, you mentioned that there were some questions regarding the fraud audit that was completed.
Oh, yeah, that would be great.
But how about if we hold that for just a moment and see if there are any questions regarding the program, the financial status of the pool, concerns that Jefferson might have that you would want to share with, through the executive committee with the rest of the board.
David and Vyrle, I wanted to just point out a couple of things. One is that thank you very much for your presentation. And as we look at Jefferson County for what they paid last year compared to this year, it's about a $27,000 difference, roughly, and translates to approximately about a 7% increase over last year, from a year ago. So when you look at some of the numbers that Vyrle was showing in terms of some of the larger counties that are more heavily concentrated in those higher dollar limits, we got off really well compared to some of the other counties. Also wanted to note and thank Vyrle, as we were looking at a $27,000 premium increase from last year to this year for Jefferson County, considered whether it would make sense to go from a $10,000 deductible, which is our current deductible, up to $25,000. We looked at that. We spoke about it in a prior meeting, but just wanted to reference it again, that with the help of doing some analysis that Vyrle was just really helpful on, good customer service. What it would have meant is, while we would have saved modestly in our premiums, just like if you've got car insurance, you raise your deductible, what you pay in premium goes down. Same situation. But what we would have then needed to do is do a similar sort of thing that the pool does, and that is sock away dollars to self-insure ourselves for up to $25,000. And so when we looked at our risk management reserve and the increased dollars that we need to put there, we need to put more money in there than we would save in premiums, and at a time when we're trying to save dollars, that didn't make good economic sense. So we've stayed, at least at this juncture, at $10,000 deductible. So just wanted to note that we had looked at that. Also, as regards to the not moving from 97 towards a goal of 98% confidence level within the pool, I was one of the voters that did vote for sticking with the 98%, thinking that it was important for the long-term, no surprises for the members to move to that 98% confidence level. So I did vote as a member of the pool for sticking with the 98 and moving towards that. So just wanted to note a couple